I recently attended Schwab's 2022 Market Outlook and wanted to share 5 highlights that I think investors should be aware of. Let's get into it. Hello and welcome to another video from One Up Financial. I am your host, Eric Persogna, here to help you increase income, reduce taxes, and invest smarter in retirement. Of all the big banks and financial institutions that I follow out there in the market, I have to say that Schwab is probably my absolute favorite. And it's not just because we custody our clients' assets with Schwab, it's because of Liz Ann Saunders and her team that just do a great job, in my opinion, of relaying complex market and financial data in a way that's easily digestible for the general public. And I recently attended their market outlook for 2022 and wanted to share with you the 5 key highlights that I think all investors should pay attention to. So number 1 is the topic of stagflation. So if you're not familiar with the term stagflation, it really just defines an economy that is experiencing 3 things. For one, inflation is high or it is on the rise. Prices are going through the roof. Number 2, a slowing economy. And number 3, rising unemployment or high unemployment. And I think there's a lot of concern out there, at least on the call. A lot of people address their concern about the potential that the US is entering a period of stagflation like we saw in the 1970s. And what Schwab does great is really just points to the data, right? So if you look at the data and you look at how you define stagflation, we're actually only experiencing 2 of those 3 factors. So what we don't have right now is a high rate of unemployment. Unemployment is still incredibly low, and thankfully we are emerging from this pandemic and people are starting to get back into their jobs and into the workforce. So if you look at the data, we are not necessarily in a period of stagflation, which is good because that generally tends to lead to recessions. So second highlight that I want to bring up is again a little bit more about the economy as well. And it's this theory or this notion of pent down demand. So if you think about 2020 to 2021, when we were all stuck at home, or at least for the most part of 2020, and the government just kept giving us money, right? Just flooding the market with cash. A lot of people were buying everything that they could because there was nothing else to do. So they bought the Pelotons, they bought the iPads, they bought the iPhones, new TVs, furniture, you name it, they bought it. And now we're kind of getting to the point where we're not necessarily seeing as much of the demand, but we're seeing more so supply side issues that are resulting in the high inflation rate. I think that's important to address because we see inflation, right? We see prices going up, but what is causing that? Is it just people wanting to buy so many things and there's pent up demand and there's not enough supply? It's not, maybe in some areas of the market. I think Schwab pointed out there were some parts of the market that you were starting to see that, that demand drive the increase in prices, but it's more so on the supply side, especially if you look at the semiconductors and the shortages of vehicles out there if you've been on a car lot and trying to buy or lease a new vehicle. That's important to address because even though the Fed is set to raise rates several times this year to help combat inflation, raising interest rates is not necessarily going to fix the supply chain issues. So I love, the Fed always uses that word transitory, and clearly, in hindsight, they were completely wrong as far as if the inflation was going to be transitory or short-term in nature. We're starting to see it's more long-term now. So I think when we look at what the Fed is trying to do to combat that inflation and prevent the economy from overheating, that might help with certain parts of the market, but it's not necessarily going to fix those supply chains. So we still could see that, and we still could see some of those issues in certain pockets of the market, like the auto industry. We could see that for the remainder of this year, or definitely not over the short term. The third highlight, and this might be one of my favorites of everything that Schwab talked about, and it revolves really around what we should be paying attention to. And there's so much information out there in the marketplace. CNN, CNBC, all these news outlets, all these articles, all this data, all these opinions being thrown at us, it's really hard to try and sit back and determine what is important, what should I be paying attention to? So I thought that was a great question that I'm not sure who brought it up in the call, but someone asked, what should we be paying attention to? What data out there is most relevant? Now, obviously, the GDP numbers and following the stock market and unemployment and CPI, those are all leading indicators that I don't think anyone would disagree are important to monitor and to kind of keep up to date with. But there are other areas that I thought, Schwab highlighted was really interesting as far as areas within the economy or key pieces of data that we should be following or should be paying more attention to. Things like ISM orders or TSA volumes, or people going out and traveling and vacationing and going on planes, open table seating, box office numbers, even key fob swipes at office buildings, those things that were really hurt or impacted during 2020, during the pandemic. Looking at those data points and seeing how well we're emerging and coming out in those areas, I think is going to be really, really helpful in assessing how well our economy is recovering from this pandemic. So I thought that was really interesting. And those are certain data points that, I'll be honest, I don't necessarily follow nearly as closely as I should, but I think that they are very good indicators of how well we're doing as an economy. Number 4, the fourth highlight is the labor market. So I think we've all seen a lot of changes in pretty much every area of the market and the economy, but one of the biggest, I think, is the labor market. And I talked a little bit earlier, I mentioned that the unemployment rate is very low, right? We're at a very low rate of unemployment in this economy. But the labor participation rate, so that is the number of people that are actually participating in the labor force, is also very low. And it's increasing, but it's increasing at a slower pace than it has before. So a lot of that can be attributed to what Schwab and I think other economists have referred to as the Great Resignation, right? So people that in 2020, 2021, as a result of the pandemic, didn't necessarily go back to their jobs. Either they were furloughed or laid off, or they quit, and they realized that, hey, I don't necessarily have to go back to work. Maybe I hit my retirement number sooner than I thought, although the past month or so, maybe that's not the case anymore. But a lot of people might have already hit their targets or hit their goals or want to pursue a passion or start a business, whatever it might be. We're starting to see a lot of people that just are not returning to the workforce. And we talk a lot about the unemployment rate as being very an important indicator to follow. It's also important to look at the labor participation rate, the number of people that are actually in the workforce contributing to the growth of our economy. And that number is actually not nearly as high as it once was, although it is increasing marginally. Another part of the labor market that I wanted to address as well was this kind of hybrid work model. And Liz Ann Saunders had mentioned that she's kind of been used to this model where she kind of worked remotely, and she would sometimes go into the office if she needed to, but for the most part, it was very flexible. And now I think that is starting to become the norm. So again, the question of, okay, is all of this change going to be temporary and eventually we're going to go back to normal? At least from Schwab's perspective, they feel like this new hybrid work model, this, I stay at home 2 or 3 days a week, I maybe go into the office a couple days, that flexible work arrangement, I think could be a lot more permanent than most people think. And a lot of us need to be cognizant of the fact that the word transitory that the Fed used, that whole temporary short-term change that we've seen as a result of COVID, a lot of those things might actually be more permanent than we realize. Lastly, number 5, the 5th key highlight was more so on the economy and the stock market. So if we just look at the economy, I want to focus more on what Schwab talked about as it relates to stimulus. And as we've all seen over the past 2 years, the federal government has put a ton of cash into the marketplace through stimulus money and through PPP loans and EIDLs and all of those government benefits that were enacted to kind of help us get through the pandemic. There's been trillions and trillions of dollars just loaded into the marketplace. And I think it's important to look at that going forward and see what the Fed and kind of what we all have learned from that process and from all that stimulus money, and see its impact and the after effects it's had on the economy, specifically what we're seeing right now with supply chains and inflation. So I think, and this is kind of how Schwab phrased it, is going forward, the Fed's more than likely still going to help out the economy and inject cash flow when needed into the marketplace. But some of those cash injections might not be as large as they were, let's say, in 2020. And they might not last nearly as long as they did during COVID. And pretty much if you look at the size of debt, which I'll get into in a little bit later, it's very hard to continue to borrow and rack up all of this trillions of dollars of debt and be able to sufficiently repay that with the amount of growth that we're seeing in the economy. So I guess big takeaway there as far as the stimulus goes, we'll probably still see stimulus support in the future. God forbid if we have another black swan event or a huge economic catastrophe, we should see some Fed support, but it may not be as big and it might not last as long as we saw during the pandemic. Now, moving on to the stock market, I think a lot of investors and even advisors are concerned that the stock market is in a bubble, right? So that prices are just inflating way too much, and at some point the whole bubble is going to pop and the market is going to drop 20, 30, 40%, and we're going to go into a recession. So again, I like looking at data, and then Schwab also likes pointing out certain data points relating to the market and earnings and price to earnings multiples. So if you look at certain pockets of the market as Schwab defined them, so for example, the meme stocks, right? AMC and GameStop. And if you look at the SPAC market, the special purpose acquisition companies, and even some of the altcoins in the cryptocurrency market, certain pockets of the market like that have already burst. Their bubbles have already expanded to the point where they're now pretty much deflated. Not entirely, but their prices have gone down substantially. While the market as a whole might not be in a bubble, there are areas of the market that have formed bubbles, but we're now starting to see those bubbles burst. And kind of sticking in line with bubbles and high valuations, some people are trying to compare now in the market to the dot-com era of the early 2000s. And if you actually look at valuations relative to earnings, right? So in 2000, we saw what's called a multiple expansion. So prices for stocks were going up more than the earnings were to support those valuations. In 2021, we actually saw a multiple contraction. So that is, the prices of pretty much the majority of the stock market were going up, but you had earnings going up at a faster pace. And that's a good thing. So, when people say the stock market is overvalued right now, I think you really have to look at the earnings, and is there earnings growth to support that increase in price? And if there is, then maybe we're not in a bubble and maybe those valuations are warranted. Lastly, I'll just end on a piece about the economy that Schwab brought up relating to the national debt, and kind of goes into a little bit what I talked about with the stimulus, in that there's a lot of concern out there that we may not be able to service our debt. And with the slowing growth, I think that is something that is causing a lot of market volatility, and it's also causing some unease with investors, just given the level of debt compared to how much we're producing as an economy. But thankfully, interest rates, at least right now, are still incredibly low. And when you look at the debt service, so how much the US government has to pay from an interest perspective, the rate is still incredibly low. So that's a positive. But if you look at what the Fed is going to do with increasing interest rates or raising rates several times this year, if they raise rates too fast and too high, then we may get to the point where that debt is going to be too hard to service without a substantial amount of economic growth. So I guess takeaway there is Schwab didn't necessarily think that was an area of concern. And I think we can hopefully rely on the Fed to be cognizant of the fact that, hey, if they raise rates too high, then that puts us kind of in a tough position to repay that debt at a higher interest rate. So while it might not be something that we should concern ourselves with today, I think it is important to kind of pay attention to interest rates and how much they increase over the next several years. Lastly, this isn't necessarily a highlight or a takeaway, but again, one of the reasons why I love Schwab. And in the presentation, the proctor noticed that in the background of Liz Ann Saunders' presentation for her Zoom call, that she had a Led Zeppelin album. I think it was like Led Zeppelin 4. And he asked her what her favorite Led Zeppelin song was. So in case any of you wanted to know what the chief investment strategist of Schwab's favorite Led Zeppelin song is, it is Kashmir. And that's probably, if I had to pick, that's probably top 10 for me. My personal favorite is the Immigrant Song. What is your favorite Led Zeppelin song? What are your thoughts on Schwab's take on the market and the economy? Shoot me an email at eric@oneupfinancial.com and let me know your thoughts. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.